let's talk a little bit about, right now, Brian, we're heading into, call it troubled waters, I guess, a
Yes.
little bit for a lot of people, right? Like, we're in the syndication business, as you know. We've done a little over $3 billion. And, also I know a lot of other people in the space. And so you've got LP issues, you got GP issues, you've got all kinds of stuff going on. So I wanted to have you on right now because a lot of people are pulling out their operating agreements. They're starting to look at waterfalls. They're starting to look at recapitalizations. So what are some of the things that you're seeing now? And what are some things that, one, GP should be doing, or syndicators or sponsors? And two, what are some of the things that LPs could be asking?
When it comes to troubled waters, it's good because people are going to keep investing. Like when the markets go down, housing crashes, good investors are going to be prepared for this. They're going to have capital on the table, and they're going to be ready to come in and buy investments. But at the same time, it becomes even more sharks in the water looking to sue you. And so you need to realize, even though you're going to go out and buy more deals or more stocks or more properties, this is going to be now, if you think your big red button was big then, it's going to be bigger now because people are looking for any payday that they can get. And that's going to be the person who owns their building or, the perceived doctor in the white coat. So you need to start locking down and protecting your assets, which means all those different layers we talked about from the first show, which is separating out your risky assets like real estate into the proper LLCs, having them flow into management companies like limited partnerships, separating out ownership from management, and then using really strong asset protection trust. And the more layers we add in troubled times and waters, then the more likely we're going to keep our money.
Yeah, because I think it's a great question. I don't want to interrupt because I think you're going to be on a great roll, but I don't think people realize when you get sued, it's too late. This
Correct.
all has to be in place. I think that's a really important point. You have to have this all in place before we get to that.
And that's the absolutely good point. And I get these calls like, hey, I'm getting sued now. What can you do for me? And I'm like, well, I can exclude the lawsuit and then set this up for the future. Or we'll leave some assets out in case you have to cover the damages and protect the rest. So if you're calling me too late, then you're too far down the rabbit hole. Even with what I do, like the high-end stuff with the offshore trust and the hybrid trust, which is an offshore trust domesticated through the IRS. Even though strongest trust in the world, the Cook Island Trust, it's still too late. And so everything that you're going to set up from an asset protection standpoint, which is avoiding lawsuits or being able to get the negotiating side back in your favor, all has to be done beforehand, before you're under attack, before the lawsuit. Build your empire, but when you build your empire, you have to think about your defenses, like the outer layer moats, the bridges, the archer shooters, the cannons. You got to put all that stuff in place if you're going to defend your castle. Well, the same thing if you're going to end up becoming an investor and building your, financial empire. We need to build the LLCs. We need to build the management companies. We need to build the strong asset protection trust, depending on where your profile lies, before you get sued.
I'd love you to correct me if I'm wrong here, but it's my belief that we should not have anything in our personal name.
Well, that's what the rich do, right? And the rule of thumb is what? Mimic the rich. You want to be rich? Mimic the rich. The rich don't own things in your personal name. And sometimes it's a hard concept to understand. And I get this call, about every other day is, well, then how's it steal my assets? Like, oh, I'm transferring title into an LLC, then I lose, control of my assets. Well, no, you're still the managing member. It's still your assets. What we want is to take the asset out of your personal name from a liability issue by transferring title, like the deed, into the LLC as a holding company. And then you want to be able to manage it. And what we're doing is separating out ownership from use and control. Use your boat, use your, fancy car, use your plane, rent out your houses, manage them, but then have your business entities, or as you scale up, your management company or preferably your hybrid trust actually be the one that owns it. And this is how we separate out, ownership from use and enjoyment. Having bank accounts. This is one of the biggest ones that I don't like, is seeing people stockpile cash in their personal name. I have $100,000, $1 million of cash because I went liquid waiting for a buying opportunity. And so now what I'm doing is waiting for an opportunity to come. Well, okay, where are you holding all that cash? In my personal checking and savings, or spread out between 4 or 5 bank accounts, all in my personal name. Well, great. I love cash. Cash is king. But what they don't realize is if you get sued personally, a fender bender, or if they're one of your rental properties and it gets pierced, all that cash is the easiest smash and grab right there. I can't move it after the lawsuit. It goes into it goes into elements of fraud and fraudulent transfers. You generally don't get sued right away. You get sued right before the statute of limitation ends, generally 1 year, 2 years later. And so what will happen is you hit somebody with your car. I'm going to use this because it's just an easy analogy. You hit somebody with your car, they get mangled, and then you see a deal maybe a month or two later, and you go buy this piece of real estate, this nice investment property. Then a year later after that, you get the demand letter in the mail. Hey, you hit Sally with your car. Now we're suing you, or give us $1 million. Well, what a judge is going to do is say, well, hey, Ken, hey, Danelli, you knew that it was foreseeable you're going to get sued by hitting somebody over with your car. So undo that investment that you did and give the creditor access back to that cash. Undo the investment, give them access to that cash. And so what you really want to do if you're stockpiling cash is put it into a bank account, a business bank account, to a management company. I prefer limited partnerships as management companies versus like Wyoming LLCs or other ones for different reasons. We can break down why. But you at least want to hold large amounts of sum of cash that are above $25,000 into a business account and not in your personal name. So if you do get sued, the cash doesn't get frozen or tied up.
Yeah, it's a good point. I'll just tell everybody a quick story. I bought a 400 unit property in Las Vegas about 10 years ago, and for the sole purpose of converting it to condos. And so let's just high math. I bought it for $40 million. At the end of the day, I was going to sell it for, somewhere in the 90 range. Basically, it was brand new. So brand new property, bought it for 40, put what's called a horizontal property regime, or, basically condoed the property. So it took an apartment building, sold it off as condos. Pretty simple. I had a nice run doing this. What happened was we had a water leak in the plumbing fixtures behind the wall. Now, this was a manufacturer issue, but of course they sued the developer. So this is when it all became real for me, Brian, because, the homeowners started suing me and the developer. But what they did is they hit the LLC, and then they had to pierce the corporate veil. And I think I just wanted to mention that it was a many-year process to get through. And I did get through. We fixed it all, and we figured it out through lots of trial and error. But at the end of the day, the lawsuit hit the LLC, and then they had to pierce the corporate veil. And I think that's the point. If all those funds and all that money would have been flowing to me or my partners individually, then they would have been able to scoop it. But in this particular case, they hit that first wall, and then they tried to pierce the corporate veil, which, by the way, they never got to. They never did. And, of course, that became the fight. Is that a good analogy?
Yeah, no, that's a perfect analogy. I had to deal with a situation like that when I was trying cases in Michigan. There's a developer, and it was over like a $40 million apartment building on Lake Michigan with the water damages. And this one was more because the storms coming off of Lake Michigan could get almost like hurricane levels, and they put in the wrong type of sealing of the windows they didn't account hurricane weather type weather coming in off of Lake Michigan, and it caused the whole apartment building to just become saturated. Mold issues turned into a $40 million plus lawsuit. And everyone's suing the developer and all of the independent contractors putting liens, contractor liens on the developer, and it just turned into a complete mess. And, whether you're the contractor or whatever, the point being is exactly what you did. At least start having some layers of defense around you, which has some charging order protections. Charging order protections, like you can go back to our first, listeners can go back to the first episode, and really we can break that down in that one. But what a charging order protection is, what Ken's kind of alluding to, is just a degree of separation of saying, how much are we going to hold the managing members of these LLCs personally liable or not? Every state is going to be different. So don't think like a charging order is going to be equal. That's where you hear about better states, with charging order protections like Wyoming, Delaware, Nevada, Arizona, Texas, Florida. Those are kind of like your main charging order strength states. The worst ones, California, Oregon, Washington, New York, like all the coasts, basically the no-go zones. And it comes down to just how you layer things. I wouldn't recommend just saying, okay, hey, I have a piece of California property and put it into a Wyoming LLC. There's no jurisdictional connection. You can't go buy another state's more beneficial laws and bring them to a state where there's no jurisdictional connection. But what you can do, and general rule of thumb, is stick the property in the LLC of the state where it's located. So if it's a California piece of property, put in a California LLC, then go pick a better state for the second layer management company with strong charging order protection. For us, we use limited partnerships, and we use Arizona limited partnerships. It's just because there's more that we can do with limited partnerships versus LLCs at that management, level.